Palantir stock is taking a serious hit today, down roughly 8% and hovering around the $190 mark. For a company that has spent much of 2025 dominating the headlines with artificial intelligence partnerships, record earnings, and a cult-like investor following, this sudden pullback has caught a lot of people off guard. So what's really going on here? Is Palantir finally succumbing to overvaluation fears, or is this one of those moments where short-term panic creates long-term opportunity? Let's break it down. First, the most obvious point, valuation. After doubling in price over the past year, Palantir has become a victim of its own success. The company keeps delivering, revenue up over 60% year-on-year, profits expanding, cash flow solid, but the stock's valuation has stretched into nosebleed territory. We're talking about forward price-to-earnings multiples well above 200 in some estimates. That's Nvidia-level pricing without Nvidia-level margins. When expectations get that high, even a perfect earnings report can feel like a disappointment. Investors look for an excuse to take profits, and this week's move looks exactly like that, a classic sell-the-news reaction. Second, the profit-taking dynamic. It's not unusual after a monster run-up for early investors and institutions to lock in gains. Many of them entered back when Palantir was still viewed as a speculative AI bet. Now that it's one of the market's darlings, they're using the rally to de-risk. That doesn't necessarily mean they've lost faith, it just means the easy money has been made. Short-term traders often trigger stop-loss cascades that exaggerate the downside. Once momentum flips, algorithms pile in, and suddenly what started as orderly profit-taking turns into a rapid sell-off. Third, we have broader tech weakness. The entire AI sector is cooling off. After months of relentless inflows, the market is pausing to ask whether valuations across the board have simply gone too far. You're seeing corrections not just in Palantir but also in names like Supermicro, AMD, and even Nvidia, the giants that helped fuel the narrative in the first place. When macro sentiment shifts from risk-on to risk-cautious, high-growth names are always the first to feel it. It's not that Palantir suddenly became a bad business, it's that investors are repricing risk across the whole AI complex. Now, let's talk about something that added extra fuel to this drop, Michael Burry's short position. Yes, that Michael Burry, the big short investor known for betting against the housing market before the 2008 crash. His hedge fund, Scion Asset Management, recently disclosed a short position against Palantir and a handful of other richly valued AI names. When a high-profile bear like Burry steps in, it's not necessarily about predicting collapse, it's about expressing skepticism toward market euphoria. Still, the psychological impact is enormous. Retail investors see his name trending, and suddenly fear enters the chat. Palantir's CEO, Alex Karp, didn't take kindly to that. He's already fired back in interviews, calling these short sellers market manipulators and insisting that their attacks only show how disruptive Palantir has become. But Wall Street doesn't trade on passion. It trades on multiples, and when those get stretched, it only takes one headline to shift sentiment. So how do we interpret this? Let's look beneath the noise. Palantir's fundamentals remain excellent. Revenue continues to accelerate, particularly in its commercial business, where enterprise adoption of the AIP, Palantir's artificial intelligence platform, is expanding faster than anyone expected. Government contracts remain sticky and lucrative, giving the company a reliable cash flow backbone even when tech spending cycles tighten. Free cash flow margins are improving, the balance sheet is clean, and management keeps raising guidance. Those are not the hallmarks of a company in trouble. So why is the stock down? Because price and performance don't always move together. In markets, perception is everything. If investors collectively decide a stock has run too far, no amount of good news will stop the short-term correction. The real test isn't today's price drop, it's how the stock behaves once the selling pressure subsides. Another factor worth mentioning is AI trade fatigue. After nearly 2 years of non-stop enthusiasm, investors are asking, what's next? AI is no longer a story, it's an expectation. Every company needs an AI angle, and that makes it harder for Palantir to stand out. This doesn't mean the opportunity is gone, it just means the narrative has matured. To keep momentum, Palantir will have to prove that its AI platform isn't just powerful, but indispensable. That means showcasing tangible outcomes, measurable productivity gains, cost savings, and mission-critical wins for clients that go beyond hype. If they can do that, this correction could set the stage for a new accumulation phase. Let's zoom out for perspective. In 2022, Palantir was written off as an over-promised government contractor stock. In 2023 and 2024, it rebuilt its story around AI. By mid-2025, it had become one of the biggest turnaround success stories in tech. So a 10% pullback after a 100% rally isn't exactly shocking. It's normal market rotation, painful, yes, but often necessary to reset expectations. From a technical standpoint, here's what matters. The 190 region represents a psychological support zone, a round number and a previous consolidation area. If Palantir can stabilize here, you might see short-term traders step back in. But if it breaks significantly below that level, the next support may not come until the mid-170s. Long-term investors, however, should focus less on charts and more on execution. As long as the company keeps growing its commercial customer base, expanding its AI partnerships, and maintaining profitability, dips like this become opportunities rather than threats. Now, let's talk about the psychology of hype and correction. In every cycle, .com, electric vehicles, crypto, and now AI, we see the same rhythm. Stage 1, underappreciation. Stage 2, discovery. Stage 3, mania. Stage 4, consolidation. Palantir may simply be entering stage 4. The stock ran up fast, valuation stretched, and now we're seeing natural consolidation as expectations reset. The key for investors is distinguishing between a broken story and a maturing story. Right now, Palantir's story isn't broken, it's being repriced. Here's how to think about it going forward. Short term, expect volatility. Analysts will keep debating valuation, shorts will keep pressing their case, and retail investors will continue to argue on message boards. The stock could easily swing 10% in either direction over a few days. Medium term, watch for catalysts. New government contracts, high-profile commercial partnerships, or product breakthroughs that clearly differentiate Palantir's AI platform, these could all shift sentiment back quickly. Long-term, execution wins. If Palantir continues to deliver 6+% revenue growth with strong margins, today's valuation concerns will look trivial a few years from now. But that requires consistency, quarter after quarter. So where does that leave us? If you're a trader, today's drop might look alarming. If you're a long-term investor who believes in Palantir's role as the operating system for enterprise AI and national security analytics, this is part of the journey. Every great growth story has pullbacks that test conviction. The market rewards those who understand the difference between temporary volatility and structural decline. And right now, Palantir's decline looks more psychological than structural. To sum up, the stock's down sharply, yes. But the business? Still strong. This looks like valuation pressure, profit-taking, and sentiment rotation, not a collapse in fundamentals. Michael Burry's short may grab headlines, but it doesn't change the fact that Palantir remains one of the few pure-play AI companies with real earnings, real customers, and real cash flow. Sometimes, markets need a reality check. This one might be Palantir's. And as always, in every market storm, volatility shakes out the impatient so the patient can build wealth quietly.